Welcome, everyone. We'll get started in a few minutes. Thank you, everyone, for joining us. I'm Linda Murdix. I'm the president of the Chicago chapter of IFMA. I'm also the global head of facilities for RJ O'Brien, a futures brokerage trading company. Welcome to the February lunch program. Thank you for virtually joining us and for bringing your own lunch. Although we are seeing strides in getting the vaccine distributed, we continue to live and work in this virtual COVID environment, and the resources and guidelines continue to change. Please regularly check out our chapter website homepage for the links to our various IFMA and City of Chicago COVID-19 resource pages. These pages are regularly updated with current and helpful information, so feel free to visit often. The chapter board of directors continues to research and offer programs of interest for our chapter members. We have several planned events for the next few weeks. We have a sponsor appreciation networking event on February 23rd. It's an annual thank you for our medal sponsors. The event is for FM professionals only. So this fun reception will include interactive virtual games and a great way to learn more about our chapter sponsors. I encourage all FMs to register and to support our sponsors. On February 25th, we'll have a virtual tour hosted by the Chicago Architecture Center, a virtual visit to the new Bank of America Tower at 110 North Wacker. Our March program is on security and safety in today's facility management world. Chicago chapter member Randy Braverman will moderate a panel of 5. Our 2020 to 2022 charity partner is Salute Inc. We encourage you to support our charity partner. Salute Inc. is hosting their annual fundraising gala on Saturday, February 27th at 7:30 p.m. It's a 30-minute virtual presentation that is an online auction to raise funds to support veterans and their families. Registration is free and the auction items are amazing. I checked it out yesterday. I hope you'll do the same. Sign up at www.saluteinc.org. I'd like to give a shout out to our chapter sponsors. Without our annual medal sponsors investing in the Chicago IFMA chapter, we would not be able to put on the programming, host happy hours, or provide ongoing member support. These companies stepped up to support IFMA during these unprecedented times, and we are really grateful for their sponsorship. Our platinum sponsors are 3MD Relocation Services, ServPro, West Loop, Bucktown, Greektown. Our gold sponsor is Beer Construction. Our silver sponsors are BOS, Clune Construction, Court, ISI, ICG, and Castle Systems. Our bronze sponsor is FMG. Don't forget to check out our Chicago chapter Facebook, Instagram, and LinkedIn pages. Please consider posting to these social media outlets to reach out and connect within our industry. Now is this time to stay engaged more than ever via social media outlets. Our IFMA Bucks program has been extended until July 2021 since the IFMA Bucket auction did not occur last July. The chapter administrator will keep track of today's attendance and will distribute IFMA Bucks at the annual meeting in July, with the hopes that we'll be back in person. So save your bucks that you collect in the past year, and they are valid for this additional year. At this time, could you please be sure your microphone is muted during the program, and we suggest that you are in speaker view for a better viewing experience. We plan to have time at the end of the program for Q&A, so either put your questions in the chat or feel free to save them till the end. I would now like to turn it over to Damla Gerhart. Damla is Senior Managing Director with CBRE, and the mic is all yours, Damla. Welcome, and thank you for being here today.
Thank you very much, Linda. Let me just share my screen here, and we'll get started. All right. Okay, so I just want to say thank you again to Linda and Christian and the entire IFMA team for having me today. I'm going to present what I hope will be an easily consumable understanding of CBRE's latest forecast for Chicago's office market, especially for all the non-economists and non-brokers out there, yours truly included. So in the event that any of you suddenly have to drop off of this presentation only 8 minutes in, I thought I might start with actually some of the spoilers, so at least you have some of the key takeaways right from the get-go. Let's start with what percentage of office-based workers we think will work remotely each week. I know this number varies a bit based on whichever headline you're reading for the day, but based on extensive research stemming from even before the pandemic to now, after 11 months of gathering data, we believe that going forward, we'll settle in around people spending about 35% of the time working outside of the office, which if you don't calculate time that way, this basically translates to about 2 days a week. Seems reasonable. Next, then, if your company was in a position to reduce the demand for space instantly, that would actually equate to a 9% reduction in your footprint. And I'll talk more about how we got to this number a little bit later on, but hang with me, because I know sometimes that throws people off from how in the world did we go from 35% of time out of the office to only a 9% reduction in space. We then predict that over time, that 9% reduction in space demand across companies will actually result in a 7.1% decline in asking rents in Chicago. And finally, we anticipate that the recovery will really begin in mid-2022, and the key word there being begin. So before we dive in, I'll just very briefly highlight the 3 pieces of the puzzle that we looked at when developing this forecast. So first, we start with making some assumptions, ideally grounded in data and reality, about what we project for the economic outlook in the future. So factors such as employment, inflation, GDP, along with what we project occupiers' space needs will be. And we realize there's most certainly going to be a changing relationship between the economy and office demand. So let's just be honest about that. I think we all agree that that has already happened, and now we need to think about how we're going to move forward. And then, of course, it's always important to consider geographic nuances. So, for example, Chicago tends to be a city where it's a lot easier for developers to get things done. And we're still kind of deciding what our footprint as a city will actually be. So think of Fulton Market, where there's still space to be developed. That's going to continue to be a factor for years to come as we consider the size of the total office market. Next, we then couple those assumptions with what we know has happened in the past with previous economic cycles. So, for example, while no crisis is necessarily the same, we know from history that there is a tendency for vacancy to move towards the long-run average after deviating away from it during periods of unbalanced supply and demand, which is exactly what we're experiencing right now. And I'll share more details about the factors playing into this whole supply and demand dynamic, which is really kind of the central point for everything that we're going to be talking about and why it's out of balance. And then lastly, we look at some of the other current supply and demand dynamics, specifically in the market that we're forecasting for. So just by way of example, here in Chicago, we have 2 of the largest towers under construction in the country, with BMO Tower coming in with almost 1.5 million square feet next year, and Salesforce Tower coming in right behind that with 1.2 million square feet the following year. And both of these buildings are just under 50% leased. So obviously that's a dynamic that doesn't exist in any other market right now. So we're clearly facing a supply side headwind, as we call it, that really just is very unique to all of us here in Chicago. Okay, so the biggest question with the most uncertainty in all of this is related to remote work, which, just to be clear, I always have to make this little caveat, encompasses more than just working from home. And we do believe that this will have a material impact on the office sector. So I'm going to start here with some detailed information about current trends and what we think this means for our future office performance. So we know that occupier sentiment will drive new demand dynamics around the world. And to better understand what exactly that will be, we've spent the last 11 months conducting multiple surveys with what we have as 126 of our biggest clients around the world at different points during the pandemic to see how their thinking started and how or if it was shifting. And I think just on a personal note, I certainly know from friends and colleagues, the way we sort of looked at this little thing happening back in March is a lot different than how we felt about it, you know, come end of summer, and certainly how we still feel about it now 11 months later. And the same thing with our largest clients. You know, they've evolved in terms of how they're approaching what the future will be. So I'll just caveat this by saying that the findings I'm going to share here are the ones that we found to be consistent across industries and geographies. And we feel the most strongly will influence how organizations think about their real estate in a post-COVID-19 environment. So the first one here, as you can see, is 61% of these major organizations indicated that all of their employees will have some level of flexibility going forward. And I'll just say, as the former lead of CBRE's workplace strategy practice for the US, spent the last 8 years doing that, I can attest to the fact that this is a really significant increase from what the data pre-pandemic used to show. Next, we know that a huge portion of these clients still believe that the office will be the destination of choice for their employees when they aren't working remotely. So what this tells us is that the physical office still has a role to play, even in a more mobile future, but it's going to need to undergo some transformation to support more flexibility and choice in the future. Now, obviously, the 19% of those organizations that don't believe the office will be a destination of choice still represents a significant downside risk that we certainly believe will have a negative impact on occupancy. And a vast majority of these organizations are planning on some optimization of their portfolios, which, you know, you hear that and people just sort of, in some cases, tend to assume the worst. But optimization, as we see it, and certainly as we've heard from our clients, it ranges from reducing their footprint a bit in some offices, not necessarily all of them, to consolidating those in close proximity, and then obviously on the other end of the spectrum, even entirely closing some locations. So those organizations, their optimization strategies are running the gamut. But as you can see, you know, 85% of them are going through that process right now. And in addition, what we've found is that 3/4 of them have actually put any expansion plans that they had in the works prior to March of last year, either on hold indefinitely or canceled altogether. And nearly 75% of them actually expect flexible office space will play some role in their future real estate strategy. And so while we've watched some of the flexible space operators fade away over the last several months, or just continue to struggle through these challenging times, we still think that they're going to have a role to play in many organizations' overall real estate portfolio ecosystem. And then in terms of location, again, sometimes where the headlines don't really reflect what, you know, the biggest companies in the world are thinking, 25% of them are considering opening a suburban satellite location in various markets, and this is actually a national statistic here, so not just in Chicago. But even in doing so, only 10% of them are actually considering leaving their urban core location. So there's, I think, sometimes a disconnect when we hear that organizations want to think about something in the suburbs. It doesn't necessarily mean that they're leaving downtown. And so, you know, we always just say we think for the most part, these suburban sites will be additive to a client's portfolio as opposed to necessarily being a wholesale replacement. Now, they may decide to reduce some of that footprint downtown and make up for it in the suburbs, but in most cases, it's not you know, becoming a full lift and shift. And then lastly, since people will be in the office a bit less, not more, the case for shifting toward unassigned, shared individual spaces actually becomes stronger. So many of these companies see this type of workplace strategy as being critical for space efficiency and actually the best way that they're going to be able to satisfy all the needs behind a more hybrid type of workforce. And based on the research done not only by CBRE, but also many other companies, including some of our competitors, we concluded that the primary reason we go into the office, once we all felt it was safe to do so, would actually be to see people in 3D, coupled with the fact that certain activities of work are just more effective when done in person. And so to influence employees to use the office and have it be their destination of choice, occupiers really need to think about what their offices can deliver that's unique compared to the experience of remote working. And I know remote working is not just working at home, but I think we've all seen people continue to upgrade their home setups over the last 11 months. And so that bar is raised even higher in terms of, well, what am I really going to get at the office that I can't get at home? And I think, again, it goes back to, the fact that the people ideally will be here and you can connect in person. And if we agree that the office's new purpose will be basically to provide the venue for community, collaboration, culture, the 3 C's, as a result, employees are going to spend less time on doing the individual focus tasks while they're actually here on site, and more of the time that they're here collaborating, networking, socializing. And so the composition of the office design in and of itself will have to adjust to reflect this change. So for example, people say, well, what do you mean? What does that mean? So we know that in some cases more collaboration spaces will be necessary. We know that they'll need to be better in terms of how they transform for future office design. So think about it. It's in the future, even when you're in the office, it's going to actually be normal for a lot of people to dial in and be remote participants, which, sometimes, that was not often the case, especially when we had clients who always said they were a very face-to-face culture. We're going to think more about things like virtual whiteboarding software, smart boards, and synchronous and asynchronous communication platforms, because they're going to lessen the disadvantages of the people who join virtually. And I think at least I've certainly been in that position where I'm the only one that's not in the room, and everybody's looking at something on a whiteboard that I clearly can't see. And so thinking about those types of technologies, when we realize in the future it's going to be really normal for some handful of the participants in any meeting to not actually physically be there. Okay, so if we feel pretty confident that employees, let's say we believe the number, that employees will spend 35% of their week working remotely, that means they're going to be in the office about 3.19 days, to be totally exact. And just as a side note, just because facts are fun, in 2019, the average employee worked 4.2 days a week from the office. So what we're saying is in the future, it'll be 1 fewer day in the office each week, which is about a 24% reduction. So when it comes to translating that into how much office space is needed, a single number, though, is not enough to make decisions and move forward. It's actually a bit more nuanced and complicated than that, which I know no one wants to hear. But there's other considerations that I'm going to go through as we think about how these changing work patterns will really evolve and what that means when all of us are trying to solve for this number around future office demand. So we combined a few assumptions and to reach what we call the overall net impact of office occupancy. So as you may recall, I stated at the very beginning during the spoilers that this would result in a 9% reduction. So let's talk about how we actually figure that out. The next thing we need to consider is how do we convert the reduced time that people are spending in the office to an actual reduction in desks. So let's just say if the average employee wants to work in the office 3 days a week, can anyone guess, this is rhetorical because I think everyone's on mute, which 3 days most people choose? And we know this based on surveys that we've done from our clients, and there's been some public information published. But while you all ponder that, I'll give you a hint. It's usually not Monday, and it's definitely not Friday. So if all of your employees are still going to be in the office on the same 3 days, then how much space can you actually reduce? And so organizations need to think about what we call this as it's an efficiency factor. And basically, you have to consider how much of the reduced demand for space can you actually capture based on what days people are actually coming into the office. And most companies want to accommodate for the days, how do I say this? I want to make sure this comes out right. most companies want to accommodate for days with a higher than average number of employees in the office. So maybe said a little bit more clearly, I think they're trying to avoid the situation where employees show up and they don't have a desk. I think that's probably the worst result, especially in an environment where organizations realize that getting people to their offices and getting them to connect is really the whole point of having the office in the first place. So our workplace strategy team has actually researched this number. Like in reality, how much of that space can you really convert? And what we're finding is that it's about 55% taking that time in the office. It's not 100% of it, which is why you can't instantaneously reduce your footprint just because people are going to work remotely 35% of the time. So then the next factor, and I think we've heard a lot about this, is really just around de-densification. So we acknowledge that some companies may need to increase the amount of collaborative space they have. And in some cases, they actually might need to de-densify their space. A couple examples I'll give there. A law firm may implement remote working, but they might, oops, because I need to start my video. Am I still here? Can you guys still hear me? Okay.
Yes.
Okay, I got a weird pop-up on my Zoom saying I need to start my video, so hopefully it hasn't been just my picture this whole time talking at you. So a law firm may need to implement more remote working, but not necessarily add in more collaboration space. On the other hand, a company whose previous space build-out skewed toward being more open may need to factor in some de-densification as it pertains to their individual spaces. So clearly this number will depend on several factors, but the average, as we've seen, is somewhere between 5 to 15% increase in footprint needs when you calculate this de-densification. And then the last factor is timing. Most importantly, timing. These changes won't occur instantaneously. So if companies could just get out of their leases, this would obviously make a much bigger splash, but we know that that just isn't possible. Besides the fact that leases are in place, there's also other lags, as we've seen, in the decision-making process and sometimes analysis paralysis that tends to delay things. And so while firms are over here working on making these adjustments over the next few years, the U.S. is going to be adding thousands of new jobs through GDP growth. So that will then, of course, have a balancing effect here, all right? And that's just about continuing to reset the table on how we're thinking about remote work. Okay. So moving on. Since my kids have been home doing remote learning for the last 11 months, I feel marginally qualified to be an elementary level math teacher. So let's just take a super simple example and apply the factors that I just covered. So if you have 10,000 square feet today and you assume a 24% reduction in days a week in the office, remember, the increase in remote working went from 4.2 days a week in 2019 to now an estimated 3.19 days a week in 2020 and moving forward. So that's that 24% reduction. So that's that first number. So if you took it at face value, which some companies initially and incorrectly do, you might just call it a day at 7,600 square feet being what your demand for space will be. However, when you realize that folks want to come into the office during the same 3 days, you'll determine that you can probably only capture 55% of that potential footprint reduction. And I will say, I know this is the Chicago call, but just, for those of you that have counterparts in other regions, we've seen the recapture rate actually be higher in EMEA. So 55% that I'm using is what, we see in the US as being that potential footprint reduction. If you're in EMEA, actually it goes up to about 70%. Then, if you consider where you may need to de-densify the space, which remember I mentioned it's somewhere between 5 to 15%, but let's just pretend it's 5%. You conservatively add back in that footprint. What you're left with is a need for about 9,100 square feet, which is how we get to that 9.1% reduction in space. Now, what I'm describing here is the aggregate, and obviously each firm will be different, and our advice for them will be unique. But what we found is that this framework has been really helpful in a number of conversations when people are trying to oversimplify what the reduction in office space demand will be. And I will caveat our little math lesson by saying that, of course, if your footprint is large enough, even the 9.1% reduction could result in meaningful cost savings, which is clearly a major driver for companies right now. So I don't want to dismiss that, but I just, wanted to clarify that's, what the number tends to be. But then finally, we have to think about how the timing of these changes actually plays out given where a company is with their lease. And then also their headcount plans, which somehow seem to change every couple of months, even in this environment. So it just adds another layer of complexity, which is why solving this critical problem around the impact of remote work and what it really does to a company's office-based demand is a lot harder than maybe some might think. Okay, enough of the math fun for today. So let's talk about what this means then in terms of an overall metro level impact. So this is our attempt to create a normalized score, if you will, for various markets. And what you're seeing here is the impact of accelerating the existing remote work trend. So in forecasting a specific market's propensity for increased remote work, we really kind of looked at three main factors. So number one, what was their pre-COVID remote work trend? Because we know in cities that had historically high levels of remote working, they actually will embrace it more widely going forward. Yet the interesting part of this, and I know I'm going to be sounding like I'm talking out of both sides of my mouth now, but it's true. The interesting part of this is that even in markets where we saw strong remote work trends pre-COVID, so Austin, Raleigh, Denver, they still had exceptional office-based demand growth over the last decade. So just something to think about. Secondly, then, we also look at the local industry mix to determine what the prevalence for remote work activity would be. We've learned that high-tech sectors are likely to see more employees working remotely. We're also currently working with Bill Wheaton, who's an economist at MIT, to actually help us determine which occupations are most amenable to remote working and are actually doing it. So our goal is to have richer data and more specificity around this as the year continues. And I think one example that I'll give is the continuing debate around call centers. I get on one call and they'll say, oh, my client has a call center and everybody's remote and they're going to be completely remote. And then a separate call, different client, they have call centers and, they're still trying to figure out, how they get them back into the office, but still offer flexibility. So I think we need to get more granular in terms of who's actually doing it and what occupations are really most amenable to it. And then the third factor that we look at is we consider which prominent office markets also have the most arduous commutes. So cities with costly commutes are likely to see the greatest propensity for remote working. So you put all of that together, and you can see that Chicago has a moderate prevalence of remote work, right in the middle section of those cities. And as a market, we don't quite have the downside of the remote work threat that some of the more concentrated tech markets have. And just a few key takeaways I think are important context behind this data, especially if you're looking at, a national portfolio. We found that digital markets are more poised to see more remote work. Cities with high in-migration historically, so, the cities that people want to move to or are moving into, those newcomers are actually coming in working remotely. Cities like LA and New York that have sizable creative and transactional sectors fall in the moderate category because the nature of their work, it has a decreased ability to be able to do that most effectively remotely. So again, creative institutions, a lot of financial institutions. And then lastly, cities with shorter commute times offer easier access to the office, and therefore, again, we consider that to be potentially less of a desire for remote work. So just a little bit of context behind how we did some of the scoring and an attempt to normalize this across, a national geography. Okay, so enough about remote work. I feel like I've beat that dead horse enough. Let's shift to talking about the economy. Okay, so let's start with looking at what we believe are some potential scenarios, keeping in mind that office using employment will recover a bit more slowly than total employment. So our baseline scenario, if you're looking at this chart, is the dark green. And that is, when we say baseline scenario, that's what we predict to be the most likely outcome. So this actually shows a relatively rapid bounce back in Chicago. But what this scenario assumes is that 60% of the population here is vaccinated by mid-year, which would help us usher in a sturdy recovery in the leisure and hospitality sector, which is obviously very important for Chicago. The upside scenario in blue, which we actually think is less likely, although it would be nice, would occur if 70% of the population is vaccinated by mid-year and unemployment falls below 5%, which is currently right around 7%. The downside scenario in light green, which again, less likely, would play out if the next phases of the vaccine distribution were bungled and many small service firms closed. And then lastly, the severe downside in pink, which I don't even really want to think about, would be a scenario where the vaccine proves ineffective against these new COVID-19 variants, which would obviously materially contract all sectors of the economy. So that's our official sort of forecast in terms of the scenarios around office sector using employment. So there we go. So as I said during the spoiler alert at the beginning, our baseline forecast is that asking rents will fall 7.1% over the next 18 months, and vacancy will peak at 25% in the year 2024. And you can look at this chart and see historically, how we've tracked that, and then, I'll give you some more context behind, our forecast. But as we've seen the recent economic shock and obviously the uncertain future have caused a lot of occupiers to delay leasing decisions. If they're not delaying them entirely, they're doing very short-term renewals. And many of them are trying to give back space with subleases. In Chicago, like I said earlier, we also have a strong supply pipeline with new buildings coming online, which obviously contributes to the rising vacancy and the initial projected downturn in rents. Now, we believe that the economic recovery rebalances in the medium term when vacancy initially peaks in mid-2022. But then, with the number of upcoming big lease expirations and what we think will be the remote work trends continuing to take a hold, we're going to see some slowing economic growth. And so therefore, we predict a second peak in vacancy that will happen in 2024. So if you look at the graph, rather than thinking about it as a double peak, we're kind of referring to it as more of a vacancy mini plateau that spans this give or take 2-year time frame before it starts to trend back down. So therefore, with all of that taken into consideration, this is why we expect a full recovery to what we call the pre-crisis rent levels. We don't think that will be achieved until the second quarter of 2026 in our version of reality today. So let's dig into the 3 areas where supply and demand are currently really struggling to find balance, and the struggle is what's causing some of the issues that I just referred to. So there's kind of 3 big areas. There's rent, there's vacancy, and there's absorption. So let's start with rent. You can see in the chart, rents were hovering just above the trend line even prior to COVID. And typically, cyclical pressures in Chicago tend to be more mild, which is why if you look back historically, you don't really see too much variance off the trend line. And so this is why we anticipate asking rents to drop just slightly, because as a market, we tend not to see big swings. Other markets have peaks and troughs that venture further away from that trend line, which is why you'll see bigger swings in terms of rent decline. And though the real estate recovery outlook has been extended 6.25 years, in case anybody's counting, to Q2 of 2026, which I mentioned earlier, this actually falls in line with previous cycles. So it's not exactly worse, it's pretty typical is what we're expecting. We anticipate the effective rents are likely to be tempered by increasing concessions, which with the deals that have gotten done, we're starting to see those. So increase in tenant improvement allowances, more free rent and beneficial occupancy provisions. So by the way, just as a side note, in case you're wondering how 7.1% reduction in rent is relative, we're projecting about a 25% rent decline in San Francisco and a 15% decline in New York. So again, going back to the fact that Chicago tends to be a bit more mild in terms of those cyclical pressures and the variances we see there with rent across that trend line. We're also going to be taking a deeper look at how this rent decline plays out in terms of the flight to quality. And we talk about this a lot. In fact, we were talking about this pre-COVID. And so we think rents will recover despite vacancy remaining elevated for a period of time, but this will be felt the most, the pain will be felt more in B and C assets that are also in less favorable locations. And so a big question then is, what happens to all of those aging assets in the market? Will they be converted to a different type of use? Will they be retrofitted to support occupiers' changed expectations? So that all remains to be seen in the longer term. But in the near term, our research and econometric advisors teams are really focusing on getting a clearer picture of net effective rents based on class of buildings and even submarkets to really shake out how the forecasted 7.1% decline plays out across different classes of buildings. And I think we suspect that that will not be necessarily felt in the same way across A, B, and C class buildings. So we hope to have more data on that in the next few quarters. Okay, so then now moving on to vacancy, which we know is the outcome of supply and demand. So Chicago's total vacancy was 20.4%, 20.4%, just felt the need to repeat myself there, in Q4 of last year. But remember, in that same quarter, we had 2.2 million square feet of new space delivered. Now add to that another 4.7 million square feet, which is currently under construction downtown, and 1.5 million of that will be delivered later this year. So the oncoming new additional supply and the continued weakened demand are expected to put this upward pressure on vacancy, and it's going to be persistent over the next couple of years. So not surprisingly, we've seen the market loosen a bit to be more tenant friendly, and we're now well above what we call the long run vacancy equilibrium, which has always tended to be around 16%. And for those economists out there, I had like a 30-minute conversation yesterday with our head of econometric advisors, just like, why is it 16%? Why is it 15%? You know, how do we get to that number? But that's basically what we define as the steady state of vacancy. It's basically where in a city like Chicago, vacancy just sort of wants to be. So that's the magic behind that number. And then the last factor with the supply and demand struggle is absorption. So negative net absorption is defined as an overall reduction in the occupied square feet of office space. So we think leasing will gain momentum, but when that even as that happens, firms will shrink their average footprint as they embrace remote work, and they'll take down fewer square feet per employee. So as a result, the overall recovery will experience that slight setback in 2024 as remote work makes its biggest impact and more leases expire alongside that, which is going to slow the recovery a bit. Okay. And if you're like me and think it's fun to look at these types of real estate metrics against past recessions, just to see how different things really are this time around, then hopefully you'll appreciate this table. But if you look at the numbers today compared with the great financial crisis in 2008 and the dot-com bust in 2001, the Chicago office market is pretty much expected to perform in line with past recessions. Like it has historically, it'll take somewhere between 6 to 8 years to fully recover. We'll deliver new supply in terms of new buildings. That's right in between what we saw in past cycles. And even the job losses are similar in numbers, although, you know, different industries. I think the big exception to this whole deja vu situation, though, is that we expect vacancy to go higher than it did in the last previous downturns, and it will stay higher, likely for a period of time. Okay, so I'll just wrap this up by saying that with all forecasts, there's an infinite range of potential outcomes. But this is our prediction based on what we believe are really carefully thought out assumptions. And all of this to say, this is really just meant to be the start of the conversation. We've covered a number of indicators here, which if any of those indicators swing one way in a different direction, it'll obviously change the forecast and what we're predicting as the outcome. But I'll highlight a few that we didn't touch on that are also important as sort of indicators to watch. So, for example, the third one on here, tenant preferences. COVID has clearly underscored the connection between buildings and wellness, and as landlords compete for tenants, differentiated workplace environments will really be those that innovate around health and well-being in the workplace. And we used to like to refer to things like outdoor spaces and touchless technology as building amenities, icing on the cake, if you will. But going forward, we're seeing more occupiers look at those things as baseline expectations, table stakes. And so that's obviously going to change, how we look at, some of the market dynamics here. And then another important one is number 6 with some of the demographic shifts. So, we're watching all the reshuffling of where people who are located on the coasts are deciding to relocate to. So, they're leaving New York and they're leaving San Francisco, but will Chicago actually be a net gainer in terms of, population and headcount coming here, especially from some of those tech companies? And so it's probably too soon to say at this point. And certainly we are a city that has its challenges, which, well, I will not get into, but even in the more recent conversations we're having with clients, we as a city still check a lot of boxes in terms of being a desirable place for companies and employees to want to be. So we're going to continue to watch all of these indicators that are shown here and certainly others and adjust our expectations as Chicago and other markets find their path. And finally, my last slide here is really just a summary of the key points that I covered along the way, which for your sake, I will not repeat. But with that, I just wanted to say thanks again to everyone for joining the call today, and certainly to the folks at IFMA for giving CBRE the opportunity to share our perspective on how we predict things will shake out here in Chicago. And with the time we have remaining, I'm happy to either take any questions and would certainly welcome any comments or even feedback on this material. This is going to be something that we continue to share on an ongoing basis and likely update and reevaluate in some ways. But if there's anything that you think would be helpful as we continue to have this conversation, I would welcome all of it. So feel free to share anything with me now or follow up with me afterward. But for the Q&A, I will just turn it back over to you, Christian.
Yeah, thanks, Damla. So we did have a couple of questions. First, from Steve Rothman, do the CBRE surveys provide any sense of how many days or frequency someone would need to come into the office that would allow them to keep their dedicated private office before being moved into a shared office hoteling model?
That's a great question. And I will say that number tends to vary by client, but typically it's sort of at the 50%, 60% threshold. So when we've had a number of clients who will do surveys where they ask their employees to sort of indicate what their expectations or preferences are for coming into the office in the future. And anytime that number starts to dip below being in the office 3 days a week, if you're saying 2 or maybe even 1, that generally tends to be the trigger point for when they say, okay, then it probably doesn't make sense for this person to have a dedicated space. Now, I will say a lot of people are smart, and you get those surveys, and people will say, oh, I will definitely be here 3 days a week. And so that certainly happened. And then obviously on the back end, that's not exactly what the show up badge data would show. So, but typically it has been, like I said, just, as soon as you get to less than 3 days a week, or maybe even less than 2.5, tends to be when all of a sudden the question mark comes up around whether or not this individual needs a dedicated space.
Okay, and then we had another one. I think this is probably coming from like a property manager or landlord standpoint. How key are amenities going to be for real estate, like cafes, workout areas, etc.?
Yeah, I think that's a great question. And I think, we've seen a couple buildings, even over the last 11 months when nobody has been in them, take advantage of this time where people are not in and out of the office to actually make improvements to some of their amenities. So we've seen building lobbies be renovated. We've seen, tenant lounges get updated and improved. And I think that will continue to be important. And the reason I say that is, I mentioned earlier, companies are saying, well, what can we give people here in the office or even in our building that they're not going to be able to get when they're working remotely, or at home? And so that's when amenities really does start to matter. Now, I will say there's a difference though between building amenities and then, an individual company's specific amenities. So, things that we saw become really popular over the last, several years, maybe the last decade, ping pong rooms and some of those other sort of, I don't want to say frivolous, but, maybe less critical type of amenities. I think we're going to start to see those kind of go away a little bit because people aren't going to come in the office necessarily to spend time playing ping pong, although that might help with some of the culture building that some clients are focused on. But I think they're going to really want to focus more on how can we create great meeting environments where we can bring a group of people here and they can have a great day together meeting on something and then go back to, wherever they do their remote work.
All right. We have a couple more questions. Who is driving the technology TI or tenant improvement requests and touchless requests? Are they coming through real estate, facilities, or are other stakeholders now playing a larger role in the space choice?
Yeah, it's a good question. And I think, this is a situation where now all of a sudden, our people team and the HR team maybe in our client organization starts to have a really strong point of view around what the space should entail, something that maybe they didn't think about before. All of a sudden, people who are in crisis management or risk management or security roles within companies now are raising their hand and they have an opinion about what the future office, should have in terms of safety and health and well-being types of upgrades. And so I would say, the driver is more people than before. I mean, typically it was, the folks within the corporate real estate organization for the most part. And now you just, this is true. You see a lot more people who have an opinion about what the future space should be to really reflect health and well-being and safety. So you're just gonna have more people, more stakeholders involved in that decision-making process.
And then Linda had a question, which I actually wrote an article about this the other day. It's basically, what are the 3 C's that are the large drivers for office space? I know collaboration was one, I believe career was one, and I'm blanking on the third, but maybe you'd have more to.
Yeah, I think it's culture.
I think so too. Yeah.
I think that's an important one, because I think no matter how great an organization has done in terms of, pivoting to remote working and, the productivity that they're supposedly measuring that, hasn't fallen, the thing that then they very quickly, maybe even almost under their breath, follow it up with, but I'm concerned about how we sustain this long term, especially when it comes to our culture. And so I think, I guess I don't know what article you read, Christian, but
it was a workplace design. Yeah.
Okay.
Yeah, no, career was more like, training within the office, like you're not getting that necessarily when you're remote. And obviously collaboration, like, yeah, you can kind of get that remotely, but sometimes face to face, especially if you're more creative, it's harder to get that, I think, remotely.
Definitely.
We'd like to thank Damla for sharing her knowledge, her expertise, and her time with us today. A $25 donation was made to the IFMA Foundation on your behalf. Total donations to the Chicago chapter of IFMA Foundation now is over $4,175. And again, thank you so much for sharing your expertise and knowledge with us. And this concludes our program. So thank you.